Hey everyone, welcome back to the channel where I teach you how to grow your wealth with smart investing. Do you want to boost your portfolio's income like never before? Do you want to invest in the most profitable sector of the stock market? Do you want to get paid each and every single month from your investments? If you have answered yes to any of these questions, then you need to watch this entire video until the very end. Because in this video, I'm going to show you how to invest in REITs or real estate investment trusts. They are the ultimate cash cows of the stock market. REITs are companies that own and operate various real estate properties like apartments, offices, industrial properties, shopping malls, and much, much more. And they make money by collecting rent from their tenants, and they pass on most of that income to their shareholders in the form of regular dividends. And most REITs often pay out monthly dividends, which means you can enjoy a steady stream of cash flow from your investments without having to do much work because it's monthly passive income. But there are hundreds of REITs to choose from, so how do you know which ones are the right ones to invest in? Because some of them can be risky, some of them can be too expensive and plain old boring if you're not choosing the right ones for your portfolio. And that's why I recommend investing in REIT ETFs instead. REIT ETFs are exchange-traded funds that invest in a basket of REITs, and they give you a wide range of exposure to various real estate markets and sectors. By investing in a REIT ETF, you can enjoy and benefit from the diversification and stability of an ETF while still enjoying high income and growth potential from those underlying REITs. And in this video, I'm going to share with you everything you need to know about REIT ETFs, everything about their performance, their holdings, the risk, the fees, and much, much more. I'm going to share with you my top picks for the best Canadian REIT ETFs that you can buy right now and supercharge your portfolio and generate that passive income on a monthly basis. Because these REIT ETFs will pay you monthly no matter what the market condition is. So if you're ready to supercharge your portfolio with these REIT ETFs, make sure you hit that like button, subscribe to the channel, and turn on that notification icon so you don't miss out on future content just like this. The first ETF I'm going to talk about is the Vanguard FTSE Canadian Capped REIT Index ETF, or VRE for short. First, let's run through the stats. It's been around since November of 2012. It has an MER ratio of 40 basis points and assets under management just under 300 million. Has a dividend yield of 2.65%, and at the time of this recording, it's trading at roughly $30.49. And since inception, it has averaged an annual return of 5.2%. VRE is a very unique REIT ETF because it has a mix of REITs and real estate service companies. It has 16 holdings, and the largest one is First Service, which is a global leader in residential real estate services. The other real estate service company is Colliers International, which is another global leader, but they specialize in commercial real estate services. These two companies give VRE two key benefits. One is diversification and the other is growth. And by diversification, I mean they operate in different regions and sectors that the average REIT doesn't, and they can grow their earnings and their cash flows faster than your average REIT. This essentially makes VRE a diversified and a well-balanced REIT ETF. But VRE is not a perfect REIT ETF, and that's because it has lower returns and yields than some of the other REIT ETFs, such as ZRE, and I will do a deep dive into ZRE a little bit later in this video. VRE has an annual return, as we saw, at 5.2%. It has a monthly yield at 2.65% that I just talked about. Now, if we compare that to ZRE, it has an annual average return of 7.8%, and a monthly yield of 5.1%. So you can see in two key areas, it's actually worse off when you compare it to ZRE. So then why would you invest in VRE? Well, one of the main reasons was that diversification and balanced nature of this ETF because it invests in real estate service companies. But VRE also has a more variable dividend history, which may not be appealing to income-seeking investors. VRE is still an amazing option for those investors who want to invest in a REIT ETF that is not purely REITs. The other main benefit of VRE is that it has a lower MER ratio than compared to the other REIT ETFs that I'm about to show you. The MER for this one is 40 basis points, and it actually may outperform pure play REIT ETFs in the next bull market, as the real estate service companies may benefit from global real estate recovery. So why should you consider VRE for your portfolio? One, it has a low MER ratio, and two, it's balanced and diversified because it has a combination of investments in real estate service companies and REITs. The next ETF I'm going to talk about is the iShares S&P Capped REIT Index ETF. Running through the stats, it's been around since October of 2002. MER ratio of 61 basis points, and assets under management of over $1 billion, a dividend yield of over 5%, and is trading just under $16 a share, and has an average annual return since inception of over 8%. XRE is the king when it comes to REIT ETFs in Canada, because it is one of the largest REITs out there with over $1 billion of assets under management. And in this ETF, you get to benefit from 16 key holdings. And the top 3 are Canadian Apartment REIT, RioCan REIT, and Granite REIT. These are some of the best REITs in the country, and they make up 37% of the fund. XRE gives you the best of both worlds. It gives you growth, and you get income. It has an average annualized return of over 8%, and that amazing monthly dividend yield of over 5%. For example, if you had invested in XRE when it launched, you would have over $50,000 today, and you would also get a steady stream of dividend income along the way, which XRE has been very consistent with. Now, having said all those wonderful things about XRE, it is not without its risks. For example, it has a medium risk rating and a 61 basis points for an MER, which is not the cheapest. It also has a heavy exposure to retail and multifamily REITs, which make up 70% of this fund. That means that XRE can be impacted by economic downturns or other factors that hurt these specific sectors. For example, XRE lost over 40% of its value during the 2020 pandemic. But on the flip side, XRE also bounced very quickly from that dropdown. It recovered to its pre-pandemic levels in less than 18 months and is still going strong today. XRE has simply shown resilience and reliability as a long-term investment. And it's my job in these videos to show you both the pros and the cons of each ETF, because I don't want to hype up each ETF and say it's a perfect option. You want to know the risks, downside, the upside, and everything in between. And to sum it up, in my opinion, XRE is one of the best REIT ETF options available in the country. It has a diversified portfolio of top REITs, and it's a great balance between income and growth potential. It has a medium risk profile and a reasonable MER, and it can handle market volatility and recover from those impacts. If you're looking for just one REIT ETF to add to your portfolio, I would recommend XRE. The next ETF we're going to talk about is the BMO Equal Weights REIT Index ETF, or ZRE for short. Running through the stats, it's been around since May of 2010, MER ratio of 61 basis points, and assets under management just under $600 million. It has a dividend yield of over 5.1%, and the stock price at the time of this recording is just under $21 a share. It has an average annual return of just around 7.8% since inception. ZRE is a REIT ETF with 22 Canadian REITs with almost equal weights. That means you get a balanced exposure to the Canadian real estate market without a single REIT dominating over the others. ZRE also has some unique holdings, such as Minto Apartments, Chartwell, and First Capital. Now, these are not your typical REITs that you would see in other REIT ETFs, and they offer some diversification benefits. Minto Apartments, for example, is focused on residential properties. Chartwell is the largest provider of seniors housing in Canada, and First Capital is a developer and manager of mixed-use urban properties. ZRE also has a bunch of retail REITs, which make up 38% of this fund. Now, this may seem risky, but ZRE's retail REITs are mostly invested in high-quality shopping centers with very strong tenants and some great occupancy rates, such as RioCan, Smart Centers, and Choice Properties, just to name a few. Now, if you had invested $10,000 in this REIT ETF when it launched, you would have around $28,000 today. And it also pays a steady dividend with a yield of over 5%. And the MER for ZRE is 61 basis points, not super expensive and not as cheap as VRE with that 40 basis points, but still it's reasonable compared to what you get. ZRE is a solid option for investors who want equal weight exposure to multiple Canadian REITs. It also offers diversification, performance, and income, and it has a low correlation with the broader stock market. ZRE is a suitable option for long-term investors who want a balanced exposure and equal weights exposure to the Canadian real estate market. The next ETF we're going to talk about is the CI Canadian REIT ETF, REIT for short. For the stats, it has been around since November of 2004, has an MER ratio of 87 basis points, and assets under management over $500 million, and a dividend yield of over 5%, and it's currently trading around $16 a share at the time of this recording. It has an average annual return since inception of around 9%. And here's why I'm a fan of this ETF and why it's on this list. REIT is no doubt a REIT ETF, But it also benefits from REITs, but also other real estate service companies, not just in Canada, but also from the US as well. It has 30 holdings and no single REIT dominates the portfolio. You get a diversified exposure to different real estate sectors such as residential, commercial, industrial, and healthcare. REIT is not a cheap ETF. It has an MEA ratio of 87 basis points. Now for some, it may be worth it because you're getting a diversified exposure to REITs, to other real estate companies, and across Canada and the US as well. So if you're looking for that type of exposure, that higher MEA ratio might be worth it. But not only that, it has been a top performer amongst this entire list of REIT ETFs that I've shown you so far, with a 9% average rate of return. That means if you had invested your money 10 years ago in this ETF, your money would have doubled by now. Not a bad thing in this market. REIT has a reliable source of income for you if that's what you're looking for. It pays a monthly dividend and the yield is around 5%. It has also been very consistent when it comes to its distributions, which is a great thing for income-seeking investors. REIT is one of the best REIT ETFs available in the country, and I highly recommend you check it out if you're interested in that diversified exposure across Canada and the US. You get to benefit from diversification, performance, and income. Plus, it has a low correlation with the broader stock market. REIT is a suitable option for long-term investors who want growth, income, and a diversified and balanced exposure to the real estate market. The last ETF I want to talk about in this video is the iShares Global Real Estate Index ETF. Running through the stats, it's been around since August of 2008, an MEA ratio of 72 basis points, and assets under management over $200 million. It has a dividend yield of 2.7%. The stock price at the time of this recording is around $27.50, and it has an average annual rate of return at 5.1% since inception. CGR is a global REIT ETF with 77 holdings, not just across Canada and the US, but across the entire world. That means you get to invest in real estate markets in North America, Europe, Asia, and Australia, and enjoy the growth and income potential from different regions and different sectors around the world. CGR owns some of the biggest and best REITs in the entire world, such as Equinix, the largest data center REIT, Diamond Property Group, the largest mall owner in the US, and Prologis, the leader in industrial and logistics real estate. CGR is not a cheap ETF with that MEA ratio of 72 basis points, but it might be worth it if you're looking for a global real estate play with different sectors, different geographies, with a one-ticket solution. And CGR is larger and more diversified than some of the other REIT ETFs that I've covered in this video, such as VRE. CGR, however, pays a quarterly dividend versus the monthly dividends the other four pay. It has a dividend yield of 2.7%. And this is also lower than some of the other Canadian REIT ETFs that pay monthly and have higher yields. So something to consider if you're looking for a monthly paying REIT ETF, this may not be an option. But if you want global exposure across some of the best industries when it comes to real estate, and you're okay with a quarterly payout, then this is definitely something to consider. And not to mention, CGR also has a great growth potential with an average annual return of 5% since inception, which is actually higher than your average REIT, which may average around 4.4%. CGR is a great option for investors who want to diversify their portfolio and benefit from a global real estate market. You get to benefit from different regions, different sectors, and an amazing track record of performance and income. CGR is simply suitable for long-term investors who want a balanced and diversified option when it comes to investing in real estate around the world. That's all for today. I hope you enjoyed watching this video on real estate investing. Real estate stocks can be a great option for income and growth potential, but they can be hard to choose. And that's why REIT ETFs are such a great alternative, because it's a simple way and a one-ticket solution to access the real estate market. Plus, you get to benefit from monthly dividend payouts. And that's why I wanted to share with you some of the best REIT ETFs available in Canada that you can buy right now for your portfolio, not just for 2024, but beyond as a long-term investor. If you've liked this video, make sure you hit that like button and subscribe to the channel and turn on that notification so you can see more content like this on investing and personal finance. And don't forget to hit that thanks button. This small token of appreciation, but definitely goes a long way. If you have any questions or any comments, don't forget to leave them down below and let me know your thoughts. But before I end this video, please do me another favor and check out the various links available in the description down below. These are the products and services that I use on a daily basis, and you can use them to track the real estate market through some of the templates that I have available for long-term investors for dividend investors that I personally built from the ground up. So definitely check out those templates available for you to download today. That's it for now. I'll talk to you in the comments section.